Mr. N. Sheshadri, Executive Director, Bank of India. Mr. Sheshadri, morning. Thank you for joining us. At Bank of India, what are expectations? Do you think this time around Reserve Bank of India could surprise the street with a CRR cut and with a rate cut?
Actually, as far as the rate cut is concerned, the market is already factored, and with an inflation quite on control and growth taking the uppermost in the minds of the policymakers, a repo rate cut, however token it may be of 25 basis point, is definitely already factored in. I would not be surprised if there is a CRR cut also, because ultimately, apart from easing the interest rate, liquidity also is of a concern. And at the moment, in fact, RBI would not be averse to having a CRR cut along with the repo rate also.
Mr. Sheshadri, however, what do you think is going to be the quantum of CRR as well as the rate cut? Do you think they're going to be a little conservative, and considering we've already seen CRR cuts in the past, it may just restrict itself to a 25 bips cut?
Since we have entered into some sort of a slack season credit, and liquidity per se is not of a great concern. Even today, the liquidity is quite easy. But nevertheless, in fact, with a growth in mind, in the larger radar, I'm sure, in fact, RBI also would look to some sort of a 25 to 50 basis point cut in CRR as well, so that the right signals in terms of growth will be given. And at the moment, liquidity also would be watched very carefully, and RBI will definitely cut CRR as they go along if liquidity is a constraint. But to my mind, the governor would definitely resort to both CRR and SLR, a repo rate of 25 basis point, and 25 to 50 basis point of CRR is something which the market definitely can expect.
Mr. Sheshadri, since Reserve Bank of India in the earlier credit policy had clearly indicated, which was in the month of March, that they will only cut interest rates if the Indian fisc is in order. Since the budget has done very precious little to repair the fiscal deficit, do you think Reserve Bank of India this time around may not cut rates also?
See, you cannot just in fact decide on the fiscal position on the basis of a few numbers there. The long-term growth, the long-term path which has been defined by the budget is definitely in place. What the Reserve Bank would be looking to is how the inflation would in fact would get fueled on account of fiscal policies. I think as far as the medium and long-term approach towards growth is concerned, the budget has articulated. There are definitely constraints in terms of the immediate reduction in the numbers, but RBI definitely would know that growth, once you get into the path of growth, the fiscal position also would ease. Ultimately, it is the economy which decides on how the fiscal position gets altered. Suppose it's a good growth with the corporates and the tax collection getting robust, the fiscal numbers which the FM had talked about in the medium term also is achievable there. If there is no growth, then the fiscal position gets what? It is actually the egg and chicken story. RBI, I'm sure, in fact, would look to the growth, because ultimately the inflation is not a major concern as far as the immediate quarter is concerned. So RBI would see how the growth, which is fueled by an expansion in the economy, would address the fiscal issues which the finance minister have very clearly articulated in the budget.
Mr. Sheshadri, let's also chat about, overview of the banking sector and what it may deliver in FY13 according to you. How do you see NIMs faring in the fourth quarter? Do you see some improvement as the RBI is going to start cutting rates?
We already seen, in fact, an improvement in NIMs. In fact, as far as the banking sector is concerned, probably, in fact, we have seen the worst, in fact, in 11-12. And 12-13, quarter on quarter, I would definitely see the NIMs improve, both on account of the interest rate cut getting passed on to the customer, and more importantly, the volumes will go. Ultimately, NIM again is a function of how the economy grows. Banking sector had seen a very minimal growth in fact 11-12, and unless and until we get back to the growth of at least about 16-17%, if not more, there will be an issue which definitely will depress the NIMs of the banks. And going forward, even with the rate reduction and full transmission of those reduction to the borrowers, the banks would definitely see their NIMs in fact improving quarter on quarter on a sequential basis.
Right. So if Reserve Bank of India this time around, if they do not oblige markets with a rate cut, do you think credit growth for FY13, if we don't get a rate cut, could slip into early teens?
See, rate cut is something which RBI has already clearly indicated is their immediate concern, because ultimately growth should get back, and the two criterion given by the governor in his earlier two addresses were, one, in terms of control inflation, which has been achieved, and second is a clear direction on the fiscal position, which to my mind the finance minister has articulated as to how growth and fiscal control, fiscal position also would be the two key issues, and there is no reason why in fact RBI should really not reduce their cut. But more importantly, it's a signal that is what the market is looking to. Capex are happening there. There is a growth. What happens between a normal growth and between something slightly above the normal growth? There is a huge amount of difference. Each business, in fact, do grow at 10 to 12%. They have created capacities. If they can take this growth to about 17-18% or around that range, then the capacity utilization happens better. There is a better utilization of the fixed assets and the working capital cycle, and that is where exactly the whole economy get going there as it is. And I'm sure Reserve Bank of India, in their analysis with the various stakeholders, have factored this, and there will definitely be a rate cut. I'm sure there's no doubt on that.
Okay, Mr. Seshadri, I appreciate you taking the time out and chatting with us today on ET Now.